Why should we care about the difference between absorption costing and variable costing? That's the topic of this last section in Chapter 21. Based on our understanding of the differences between the two methods that we explored for laser save in October, November, and December, we figured out that whenever the number of units made equals the number of units sold, operating income will be the same under both methods. When the firm makes more units than it sells, then operating income will be greater under absorption costing than it will under variable costing, because under absorption costing, part of the fixed manufacturing overhead for the period becomes capitalized in the recorded cost of the ending inventory, so it doesn't show up on the income statement. By contrast, whenever the firm makes fewer units than it sells, then operating income will be smaller under absorption costing than under variable costing. This isn't just an accounting curiosity. The truth is that decisions are only as good as the information and the skills used to make them. GAAP requires absorption costing for external financial reporting. Someday, you may consider investing in a manufacturing firm, but before you do, you should check the balance in the firm's inventory at the end of the current period and the previous period. If you see that the inventory value has increased between last year and this year, remember that's going to make income under absorption costing higher than it would otherwise be, because it pulls some of the fixed manufacturing costs for the period onto the balance sheet and away from the income statement. By contrast, if you see that the value of inventory has gone down, that means that operating income is artificially lower, because when the firm sold some of the goods that it had made in a previous period, it pulled some fixed overhead from that previous period onto the current income statement. In addition to the financial implications of the difference between absorption costing and variable costing, there are also managerial implications. GAAP requires firms to use absorption costing for external financial reporting. But you should not use absorption costing for certain internal decisions. For example, if you use absorption costing to decide whether managers deserve their year-end bonus, you are giving those managers a tool to manipulate income. Remember that all the manager has to do to increase their income for the period is make extra units and store them as finished goods at the end of the period. This would artificially increase the reported income for the period and might help a manager to get a bonus that they didn't actually deserve. We've already seen that under absorption costing, our understanding of the manufacturing cost per unit will seem lower if the firm makes more units than it sells, but higher if the firm sells units that it had previously made in a past period. Therefore, absorption costing doesn't work well for understanding manufacturing costs. In our laser save example, we saw that the firm appeared to be much more efficient in November and much less efficient in December. But those differences didn't come from changes in fixed or variable costs. They came from changes in the inventory level. So absorption costing is not a good way to understand production efficiency. Remember, we are what we are rewarded to be, so make sure that you pick the right tool to assess who deserves to get that reward. The final method that we need to think about is which method, absorption costing or variable costing, we should use for different managerial decisions. We need to pick the right tool for specific jobs. For example, when it comes to setting the selling price, in the long term, you really need to consider absorption costing because both the fixed and variable manufacturing costs need to be covered by the selling price in order for the firm to make a profit. But in the short term, variable costing works very well because we assume in the short term that the fixed costs are fixed. In other words, the firm is not going to open up a new factory or close down a production line. When it comes to controlling costs, again, in the long term, we need to think about absorption costing. We want to make sure that we're getting good value for our fixed assets. But in the short term, variable costing is a better measure of whether we're using our costs wisely because the fixed costs are fixed in the short term. We also need to use absorption costing for long-term production planning because we want to make sure that we have the right amount of fixed manufacturing overhead items for the level of production that we expect to have in the future. But in the short term, those fixed overhead costs are fixed. So we should focus instead on variable costing. To analyze profitability, we need to think about the sales mix. Remember, that's the proportion of various products that we make. And for that, variable costing is the right tool because we're looking for the products that give us the best contribution margin. Speaking of contribution margin, if we're doing anything related to cost, volume, profit analysis, we should focus on variable costs because in that scenario, we assume that the fixed costs are fixed. This is the end of our work in Chapter 21.